Welcome to the Startup Grind. Ladies and gentlemen, please join me in welcoming John Burke. How's it going, John? Awesome. Well,
never been welcomed by a cheer before, though. That's very nice.
So actually, I probably took a good 8 months to get you as a speaker. So glad to have you finally here.
Glad to be here.
So thank you very much. We always like to start our fireside chat on a personal note. So you can talk about where you're born, where you're raised, perhaps what your parents did, and let's talk about your first taste of entrepreneurism as a 3-year-old, maybe? No?
Wow.
As a teenager? Okay, let's talk about that. Let's start with
you.
you.
Now this. So I was born, I'm a 4th-generation Californian. I was born in the Bay Area, just north of the Golden Gate Bridge in a place called Marin County. My father worked at San Quentin, which is a state prison. And I grew up within about 6 miles of the prison my whole life until I turned 18 and went to Berkeley. So the first entrepreneurial experience, you did ask me that. So I always had an interest in taking things apart, trying to put them back together. So as a kid, I did have a business where truly as a kid, where I would fix stuff for the neighbors. So whether that was TVs or chairs or anything, and that probably led to my interest in making furniture today. But that was my first business.
Cool, yeah. Awesome. Can you talk about perhaps the first couple of businesses that you had started and how that sort of helped you become a wise sage of investing now? So.
Sure. So I always wanted to have my own company. I always wanted to be a founder, and so all the classes that I took at Berkeley were sort of oriented towards that. And while all my classmates were actually interviewing for jobs at Goldman and places like that, I actually went around and interviewed at startups in the Valley when I graduated. And startups don't come to universities typically, so you've got to go out and seek them out, which is actually one of the foundations for our tech program, which I can talk about if you want. So anyway, so I found a startup that I wanted to work for and went to work for him. It was a great experience and a miserable experience altogether. But I learned a ton about working in a startup, working with the founder, stock options that were promised and never delivered, things like that. So it was really an interesting experience for me. And I was a mechanical engineer, I was not a CS, so I didn't take any, I took a couple of programming classes in college, but not many. I've learned everything I see on the job. And then decided to leave that. Went to work for a large company in San Francisco, which was always sort of a dream of mine as an engineer. So I went to work for Bechtel Power, which built nuclear power plants, which was a great experience. And then we decided, I got married as a child, and my wife and I decided to move, and because I wanted to start a company. And so we did. So not many people move from the Valley to start a company, but I did. Like I said, to me, the east shore of Tahoe was the East Coast. I had no idea what was the rest of the country. I learned to walk on a United Airlines flight to Chicago, because my mom was from. So anyway, so we moved, and I started this company. I'm not a very creative person. I feel that I can kind of copy other great ideas and execute better than other people. And so that was my plan. I was going to start this company and find some great application. Now, you're all way too young for this, but there used to be a chain of stores called Egghead Software when I was a kid in college. And I wanted to have a piece of software on the shelves at Egghead. That was sort of my dream. To have a product on the shelves. Anyway, and so I went around, started this company, and just did programming for companies. So we programmed for the YMCA of the USA, the American Red Cross, and a bunch of these big organizations down on Brad Street. We ended up writing Federal Express's international shipping software, and it was a great ride.
FedEx?
Yeah,
Federal
FedEx.
Express?
Yeah, FedEx. It was a great ride, but it was not something you could package and put on the Egghead shelves. So anyway, I sold that company, but that was really the first company, and really the only real company
that's BMI software.
Correct.
Okay, got it. Actually, so
which doesn't stand for anything, so you don't have to ask me for that.
Okay, right. Actually, I clicked on it, and it went to a music site.
Yes, it goes to BMI Music.
Okay, got it.
All my friends ask for Burke making income, but it doesn't.
Sure. So you sold your company in 1997, BMI Software.
Correct.
And you decide to actually go into the money side. You're sort of an engineer at heart.
I actually didn't. That was not a very conscious decision. Okay. I decided to sell everything, and for a lot of reasons, but I didn't want to grow old where I was living. And so we decided to make a clean break, and my wife quit her job, and I sold the company, we sold our house, we actually moved all of our cars back to Pennsylvania, and I took a couple of years off, went to business school. And it was, and then somebody told me, they said, well, what are you going to do during the summer? And I said, well, I don't know, I'll travel around, I guess, I don't know, do something. I hadn't really thought about it. And they said, well, no, you have to do some sort of job, you have to get an internship, you have to do something productive with your life. And I said, why? Because I was 30-something, 32-ish. So I was 2 standard deviations out from the average age of business school. I was married, had a kid. And so anyway, I just thought, well, somebody said, well, what do you like to do? And I said, well, I really like starting companies. I really actually didn't really like running mature companies. I really liked the idea of starting something from nothing and creating something valuable. One of the greatest things that I did in my life was answering the phone with somebody. You called 1-800-GO-FedEx and you said, hey, I'm shipping pens to Saudi Arabia. They would say, hang on for 1 second, and they would transfer us. We operated the call center for Federal Express International Shipping. And I would talk to these people who were actually using our software we wrote, which I thought was really cool. That to me was a really fulfilling thing. So I really liked creating something from nothing. And they said, oh, you should be a venture capitalist. And I said, well, what's that? And so they told me, and I couldn't even spell it. But so I spent the summer in business school going around and talking to venture capitalists who had been in the business. And somebody suggested, well, don't go interview with anybody that you're going to want a job with, so you can ask all these stupid questions first. And then when you go back for a job, you go back to people who are actually going to hire you. So I talked to people like John Doerr and David Counts. I'd never heard of them, but they all answered the call, and I could sit down with them. And so I interviewed with all these people. It was a disaster. And just talked to them and found out what the business was like. And it sounded kind of cool. You start a lot of companies, and you can help out, and you can be useful. Some people are more useful than others. And so that's what I did. And that's how I got into venture capital, actually.
So you figured that if you...
It wasn't the money side, so to speak. It was the starting company side.
Started multiple companies.
Right.
Okay, got it.
That's what the draw for me was.
Got it. So instead of creating your own single company, you can now look at other... Okay, got it. That's great. I actually wanted to go straight into the True Venture story. By the way, please tweet out at Startup Grind, hashtag Startup Grind, at True Ventures, and Twitter handle. And
so I came up with this Twitter handle. I'm not going to tell you what it stands for. I came up with this Twitter handle, Tony Conrad. We were at an offsite, and Tony says, hey, John, there's this really cool thing called Twitter. We got to be all over it. I'm like, okay, well, what is it? And he couldn't really, it was like, And he said, you got to come up with a name. And so I won't tell you what it stands for. But I came up with this weird name, which I should not have done, but I did, and it stuck. And that's why I have this stupid Twitter handle, which is Endemka.
Okay, so at ANDEMKA.
CA.
I'm sorry, CA.
Yeah.
Endemica.
Endemka. Whatever. It's stupid. I know that's stupid, but I can't change it now. Tony rides me about it. Anyway.
Don't tweet that out. So let's talk about the True Venture story. I mean, how did it come about? As I understand, True Ventures is sort of the third fund that you started. It's more or less the same partners.
Yeah. Sort of.
So what was the aha moment? Why did you just decide to start True Ventures? Why didn't you just keep the old name? Let's talk about that. Why did you start True Ventures?
So out of business school, I was hired by ABS Ventures, which was Alex Brown's venture group. Alex Brown used to be an investment bank up in Baltimore. That's why I'm here. That's why I moved down here. And so Phil Black and I, my now partner Phil Black, and I started in August in the late 90s when I graduated. And we started together. He was a partner at Weisbach and Greer, which is, again, changed names now. So that's when we started working together. And Bankers Trust bought us, then Deutsche Bank bought us, and then the markets blew up. And so we opened this big, beautiful office down here about a block away at like 1:30 in the afternoon, and at 2 o'clock the markets crashed. And so Phil had moved back to San Francisco by then, and we decided that we would form a small fund. We didn't realize actually how small it would be, but we started a small fund called Blacksmith Capital. And we started that we had our first close in July. I feel like I'm getting burned from this thing. July of 2003, and that fund still exists. We needed to raise, we wanted bigger scale. So I was here, he was in San Francisco. We needed more scale, and Phil and John Callahan had worked together as Summit Partners way back in the day. and John was coming out of what he was doing. He was working for another venture firm. And he said, look, I love what you guys are doing. You're doing all this early stage stuff. And I'd love to be part of it. And so the three of us got together and formed True Ventures. The reason it's called True Ventures, the reason it's called True Ventures is because John had a bike company. John grew up in Jackson Hole, Wyoming, and had a bike company, which is still there in Moose, Wyoming. And the hardest thing for him was to true the wheels of the bikes. And it was, once you got it trued, and we're all bikers, we're all bicyclists, and once you got it trued, it was much easier to ride that bike, right? The resistance is much less. And so we felt that we could create alignment between the GPs and the firm and the LPs, or the investors, and the founders, right? And so creating that alignment between those three entities was what we wanted to do. Talked about align a bike wheel, so we named it True. That's why it's called True.
And actually, that's a really amazing.
And that's actually not just marketing BS. Actually, that really is why.
No, but that's a very amazing philosophy, because my next question is, how did you get like a Tony, Conrad, and Om of Giga Omni? How did you recruit those guys? How did you get them to?
Well, we did.
Join your firm?
So we invested in them.
All right, next question.
Tony was coming out of VSP when we did Blacksmith, and so he shared an office with us at Blacksmith in the Presidio in San Francisco, and Tony and Phil are they're basically neighbors in the city, but they'd known each other they did the original they both invested in Oddpost, which was Toni Schneider's company. Toni Schneider is also a venture partner with us. And so that's how Tony Conrad really got involved. And then so Blacksmith seed funded Sphere, which was named Yodel at the time, but it was Sphere, which we sold to AOL. And that's how Tony got involved with us. And then he just was there at True, at the founding. And Om was the first check we ever wrote at True. So we gave Om a check, which he never cashed. He like Matt Mullenweg. Matt Mullenweg lost his check, but Om used his check as a bookmark. He never cashed it. But that's how we got involved. There's more of a history between Om and Tony, which I can talk about if you want to hear it, but whatever.
Now that you talk about Matt Mullenweg, so I wanted.
Did you ask me the AHA question? Because I didn't answer the AHA question.
Well, you talked about True. Wasn't that sort of the aha moment?
No,
it wasn't. Okay.
Why we formed True?
Yeah, I mean.
So True, we felt this was a market positioning story for us. There were lots of big funds that were getting bigger, right? And there were angels. This is back. I was telling Evan this earlier today. This is back in late 2005. So we raised, like I said, Blacksmith 2003. We're running it 2005. We decided to raise more money, form True with John. And there were angels and there were big funds. There was really this seed gap that we saw. The Series A guys, the big funds did not want to go down and do the seed deals, and the angels did not have enough capital to do the deals. And so we really saw this market gap, and that was sort of the aha moment of, okay, we can actually produce a fund that is oriented 100% around founders and actually do seed deals as an institution. So that was what we did.
It's almost like the, would that count as like micro VC? So Jeff Clavier, who I actually...
Yeah, some people do refer to us as micro VCs. We don't think that's very nice.
Okay, got it. Right.
No, they haven't done it in a while.
I was just trying to be nice about it.
No.
Micro VCs. But no, let's talk about that. Like, so you have 4 funds now, right, under True Ventures.
Correct.
Fund 1 was basically all software, where you had invested into Matt Mullenweg. Really nice guy. What did you... Okay, wait, you're going to say something?
No, go ahead.
Well, I was gonna ask about, like, with Matt Mullenweg. That was the first check, his first check for Automattic before he started the WordPress. Right?
Well, actually, not technically correct. So Blacksmith invested in Automattic.
Got it.
So Tony Conrad and Om Malik. Om knew Matt when he was a kid in Houston. He was 16 or 17. And so they brought him out, and Blacksmith invested in Automattic. And so Blacksmith was one of the 10 deals that we did at Blacksmith.
Right.
It's the only one still alive.
No, it is. It is once in a lifetime.
Yeah, and so there's some technicalities to it. But anyway, so Blacksmith invested in Automattic, And then in the next institutional round was when True did it.
Okay, were you involved with that when Black had invested in Automattic?
Oh, I was one of the two partners, yeah.
Okay, so when you had met Matt...
Tangentially involved.
Okay, tangential. When you guys had met Matt, what did you see in him? So, I mean, there could be a Matt Mullenweg here. By the way, Matt Mullenweg is the founder of WordPress. That's one. I mean, we use that for Startup Grind. It's one of the biggest like sites out there.
That's why Automattic is M-A-T-T. It's Matt in the middle of Automattic.
We couldn't spell. Oh no, I'm sorry. He didn't know how to spell. But I mean, the thing is, what did you see in Matt? And what was sort of the attributes that you said, let's invest in this guy because he could be.
Yeah, it was Om liked it, which means a lot, and it was a beautiful product. Right, and he was
the design. The design
and he was totally passionate about it. He wanted to change the world with it, and that was enough. Okay. And that was enough.
And so in Fund 2, that's basically software and then maybe 25% hardware. This is where you invested in Fitbit with James Park.
Yeah, James was out. I mentioned these offsites. We do it 4 times a year. And James came, and there's a super high hit rate if you actually pitch during an offsite. That's almost everything we pitched in offsites. So anyway, James came out, James Park. This Fitbit was not a company at the time. It was really just an idea. He had a mock-up of what he thought the thing might look like. He came out to the house where we all were and kind of hung out. He talked about this, about the decreasing commodity costs of sensors because of the iPhone and all this kind of stuff, and made this argument because none of us want to do hardware. Made this argument that hardware was going to follow the same curves that software had followed, and it made sense. And it was a very compelling story. We'll
cover about wearables a little later, but we'll get more into. But I wanted to really just the attributes that you saw in him that made you invest in him. So he was just a very tenacious character. By the way, he actually spoke at Startup Grind 2014, just a couple months ago. I spoke to him in the back. And I'm not his brother, by the way, because people are like going to be like, Park is the most popular Korean name, but we're not brothers. But I mean, he sort of came across as like very just tenacious and just passionate, and you can just
the word. He's passionate.
You can see it, you can feel it, you can totally feel it. So I think is that sort of the things that you look into.
Yeah, it was a single-minded focus on doing one thing, right? Which is what I think everybody should be doing, and that's what he did. And he was trying to change, an industry that nobody thought about changing. So we certainly didn't change. We're not prognosticators about the future and all this kind of stuff, but he really had this very clear vision of changing it, and it was phenomenal.
Okay, now I want to talk about the Fund 4, which you raised $290 million in its totality.
In aggregate,
What's the focus of this fund?
Same focus as Funds 1, 2, and 3. It literally has not changed. It is finding the best founders who will take us to the best places. Without a doubt. I mean, who thought we would invest in a drone company? Who thought we would invest in a coffee company or a hair coloring company? None of us did. Or a 3D printer. Nobody thought that. We don't know anything about that. But invest in the best people, they will take you to the best markets. That's what we do.
Okay. According to Crunchbase, it said that True Ventures has invested up to 250 startups. You said 200, so 200. But you have 100, possibly more active investments. So...
Well, it's not like a mystery. Yeah, we have about 148 active companies.
148, okay.
Yeah.
So if you could just name one, what would be the biggest winner? And that's the first question. The second question is, in your current portfolio, who do you think will be the biggest winner?
Well, I'm not going to tell you who's going to be the biggest winner. They're all wonderful.
It's like a father, right?
And Goodreads was a great exit. And so one thing that a lot of people get confused, we don't look at the sort of enterprise value. We look at our ownership. So we are very ownership centric. I think much more so than other firms. I've never worked in other firms, so I really can't speak to that. But we are ownership focused. We obviously want to own the most for the least, right? I mean, that's the whole tension. But we want to own a certain percentage of the company, and at a successful exit, we want to own a certain percentage of that company. So we don't want to own 3% of everything. That's not the model. We want to own a significant portion of a company, and so we're very ownership focused. So yeah, MakerBot was sold for $400 million. We owned a tiny piece of that. It was, I think they can blame me for that, but we owned a tiny piece of that. And it was not representative of the kinds of deals. Automattic is not representative. We don't own a huge piece of that.
Actually, you're very transparent about the percentage of the percentage ownership that you invest in. Actually, your last interview, you had mentioned it.
Did I?
Yeah, Always Prep was the founder was very surprised you talked about it, but you guys are sort of like on the lower end, which makes you competitive. But you had said that, you try to exit around 20%.
Yeah, if we can own in the mid to high teens of a company at a successful exit, we'll be successful, and our LPs will be successful, and the founders will be successful. So that's what we want to aim for.
Yeah,
right?
I mean, that's actually on the lower end, which makes you very competitive. So that's.
Yeah, we'll try and get in higher than that, right? Our
Okay.
whole thesis is based upon getting in early, writing a check that will own a significant piece, so whether it's 20 or 25, or we don't go much higher than that, but that much of a company, we can always come down. We can never, in a winning company, you can never go up, right? Everybody wants to invest in a winning company. You can't buy up in a winning company. You can buy up in the crappy ones, but you can't buy up in the winning companies. So we can only go down. So we don't just write a check and let it get diluted. We will maintain our pro rata as far as we can.
So there's a lot of startups here. I'm sure they're going to try to pitch you afterwards. I have a question about that. So can you give me a percentage of startups that you actually funded where you had met founders either at conferences or a cold email versus referral coming from someone you trust? Can you give us a certain percentage? How many startups have you invested, or was it cold email?
Let me think. 0? Right, 0.
Not even one?
Not even one.
Okay.
Phil claims we did one. I don't think so. It's 0. It's 0. The cold call email is a non-starter, super low percentage game, right? That never gets anywhere. The lawyers and the accountants, are there any lawyers and accountants in here? Yeah, wonderful people. That is a higher percentage, but still relatively low. The place where we get, where the most successful referrals we get are from the founders in our portfolio. Period.
So after this interview, you guys are going to go to True Ventures portfolio, look them up, and look up all the founders.
Yeah.
Take them out to coffee.
Yeah. I mean, with a portfolio of 400 or 600 founders, whatever the number is, you all know somebody in the portfolio, right? And they know you, and you've worked with some, or you've worked for some, or they worked for you. You know them, and so that's the way to get. And that's not just us. I mean, that's the way. I mean, what was it? I'm drawing a blank on the name. Anyway, some venture firms don't even put any contact information on their website, right? I mean, getting in through the portfolio is clearly the best way to get.
Actually,
I mean, we invested in Milo because we were sitting around, and Tim Young, who had a company that we sold to VMware, but Tim Young was sitting around. He's saying, "Oh, I was talking to my buddy, and you guys should invest in it." And it was a Friday afternoon, having a beer in the office, and by Monday we had not quite a term sheet, but we were very close with investing in Milo. And that's how it happens. That's how it happens.
So Jack Abraham.
Yeah.
So we actually had his dad here, ComScore founder.
There you go.
But
Neighbor.
Jack is actually he's from this area.
Yeah. He's a neighbor.
So actually, just talking on top of adding on what you had said there. I mean, Techstars and YC, they sort of do the same thing as well, right? If it's founder refer, they're very notorious to do that. But like getting a founder referral, that's a high grade.
I mean, I can't think of a better way.
Okay,
I mean, it's by far and away.
And then the other thing too is that to get coffee with the founder of a portfolio company is actually not that hard.
Right.
Right. I mean, it's pretty easy. I mean, most of them will probably say, "Yeah, let's grab some coffee."
Right.
If you ask them.
Right.
Again, please tweet out #StartupGrind at True Ventures at Endemica. Okay. Let's talk about your investment thesis, megatrends, and more specifically, megatrends in the next 18-24 months. Okay. So you. Or less.
No, let's talk about it.
Okay, let's talk about it. So you're known. Well, so you've been known to say that you invest in creators of movements, or three people's in an idea that are disruptive.
Was that again?
Three people in an idea.
Yes.
Creators of movements in disruptible industries.
In big markets.
Big markets.
In
okay.
big markets.
Okay.
I mean, yeah.
So let's get to the chase here. So let's talk about some of these markets. How big do you think wearables going to be? I mean, obviously you invested in Fitbit, but how what is it going to look like? You know, let alone 18, 24 months. What's it going to look like in 10 years? Are we going to be? Is it going to even be a word? Is it going to be embedded? So it's not even.
It'll be embedded. And Fitbit's not the only wearable device we have. We have also Valence Cell down in North Carolina. We have 2 others that I think are still in stealth. I won't say their names just in case they still are. You know, where it's embedded in clothing and all that kind of stuff. So it is truly embedded. It won't be something you put on. It'll just be something that's always on you, whether it's on clothes or it's some people talk about embedded in skin. But certainly within the next 24 months, it will all be in clothes.
Okay.
Shoes.
I just heard. Yeah, shoes. That sounds good. What about? So, actually, when I was actually writing or thinking about the questions, I was looking at Mary Meeker's 2013 PowerPoint, and she had talked about like the trends, mega trends, and she had talked about wearables, drivables, drones. Do you have an opinion about driverless cars, drivables?
We don't have any investments. I was telling you earlier
Yeah.
that, you know, Daimler-Benz put the first automated drone truck on the road today on the Autobahn, completely driverless. And, you know, we don't have an investment at that, but clearly.
Will you? Possibly?
Maybe. Who knew? No, really, we are led into these investments by the founders. I mean, it is, you know, we have an underwater drone company. Who thought that? I mean, but these guys are just spectacular, right? When we did 3D art, when we did 3D robotics, it was the first time we thought about it, right? I mean, it was the first time I was an RC helicopter pilot, but you know, we didn't think about drones. And when Chris Anderson came and pitched us, it was just amazing. You're just like, oh my God, yeah, of course. Everybody's going to have one of these. And so we're not, I shouldn't say it, I've never worked with a firm, but I assume that lots of other firms do this whiteboard analysis where they think about markets, they think about disruptive markets, and they do the white space analysis and gap analysis, and they figure out, okay, we're going to invest in this spot, and they're going to talk to every company in that thing, and we don't do that, right? We let the best founders come to us and tell us what they're working on, the most outrageous things they're working on. Amy Yarrett doing the hair coloring thing, I mean, whoever thought that? I mean, when Bree pitched
drones with hair coloring, what?
Could be. When Bree was one of the best. I don't know if any of you know Bree Prentice in New York, MakerBot founder. But when he pitched us, we were all in New York for something, and again doing some sort of offsite. He came in and pitched us. He was clearly the most passionate guy I have ever met in my life. I wasn't totally assuming that there would be a 3D printer on everybody's desktop within the life of the investment. But you know, there are more, and it's been a phenomenal success for them.
So I want to touch base on that 3D printing, because that was actually going to be my next question.
Sorry.
Tony Conrad had believed in Bree Pettis when nobody wanted to invest in 3D. I was reading this article, I think it was on Mashable. It was one of those things. They said that at that time nobody wanted to invest in 3D printing, and
but it wasn't an investment in 3D printing, it was an investment in Bree.
Bree, right. So that's what I was like. So for Bree Pettis, you guys invested in him, not so much the idea.
Yes. 100%.
His idea is on his back. It's investment.
100%.
And so I know you had talked about this, but it got sold for $400 million. You're saying 600?
No, I'm sure.
Okay. For Stratus.
We did not own 25% of that.
Okay, understand. Yeah. But do you think that 3D printing is going to be everywhere, just like an HP printer in everyone's
home? At some point, when you can print out of other materials as well. Yes, I do.
Okay.
I do. Costs got to come down, but the quality's got to go up. It's got to be out of metal, which you can do that today.
Sure.
Yeah.
What do you think about drones? So, what do you think about the Amazon announcement where, you know, Bezos is having this drone?
Jeff held the thing. Well, that was actually one of our drones. That was one of the
one of your drones.
3DR drones.
Oh, wow.
But whether or not that actually comes to fruition, that's just kind of fraught with issues. But who knows? Maybe. But you know, there are lots of other applications for the drones, other than disturbing helicopters here on the mall today or yesterday, whatever that was. But for agriculture, I mean, so not sightseeing, but surveying and big, huge farms, they're using it today. And you put in high-resolution cameras on them, and these are not. So the drones you see flying around, people are actually controlling them with their iPad. that's one thing, but you can actually, on the iPad, create the autopilot with the 3DR drones, where you can actually draw out a plot of the farm in tremendous detail, and then you just put it away, and it flies that, right, repetitively, and then comes home when it's done. That is pretty amazing, and that's what 3DR does.
What do you think about privacy, though, with drones? I mean, isn't there going to be a huge privacy issue? I mean, I think I heard on the news that some lady found a drone like hovering near a window.
Yeah, it's an issue.
Big
Operator
issue.
error.
Operator error. Okay, great. And actually, the other thing too I wanted to mention is that the biggest drone user group is actually based here in DC. So I read it somewhere. So possibly,
right?
yeah.
I did not know that.
But there could be possibly more investments in drone ideas.
Yeah,
Pocket Drone is based here in DC.
I don't think we would invest. I mean, we don't invest, unlike other high-volume shops, we don't invest in competitive companies. Now, some would say, well, Valence Cell and Fitbit are potentially looking after the same markets, but they're not truly competitive. And so we won't do that. We don't think that that's the right thing to do. So we will not invest in another competitive drone company.
Got it. What are some of the red flags for a startup when they pitch you? You've been known to say that if a startup talks about valuation at first.
Well, if you lead, actually that was Ron Conway's comment.
Sure,
I actually
okay.
stole it. But so if you lead with valuation, that's a yellow flag.
So
right?
why is that? Why is that?
Because you shouldn't be worried about that. And this is a California-centric mentality, but we're in it for the win. We don't really want to engineer a term sheet so that if you're kind of successful, that we'll make some money. We want it to win. We either go into this, either going to lose all our money or we're going to win big, and that's our attitude from the get-go. And that's just the way we feel about it, right? And so if you're in there thinking, trying to get this valuation and worrying about it, we want it to be a winner. We don't how you get in, whether it's 3 million or 6 million. We're worried about ownership. We want to get ownership, but we want this thing to be a winner. So it just, I don't know, it doesn't really, it's always a yellow flag when people start talking about the valuation. But red flags, so how'd you meet your founder? On LinkedIn. Oh, really? Great. That's a bad one. That one fell apart. That was actually a local company. We were on video with California. I hadn't actually asked that question, and somebody else did. And I could just hear the air come out of the room when he said, oh, on LinkedIn 3 weeks ago. Oh, really? Oh. Thanks for coming in. The married couples, blood relations working in the company, that's pretty much a red flag. There is some disagreement about that, but for me, I've never had good success with married couples. You always end up firing one of them, and that's always ugly. So that's a red flag. That's one of the main red flags, actually.
No, that's really interesting. I mean, when I had interviewed ComScore founder, I mean that's a husband-wife co-founding company, and he had sort of his opinions about that, but he said it's probably the best thing for him. It really depends on.
Totally depends
on the person.
The statistics would say that it's a bad thing. Cisco, perfect example.
Sure. But okay. So back to valuation, though. I mean, would you say like raising the minimal amount of money to get to a particular milestone, would that be good sound advice, or try to raise as much money as much?
That's what I say.
Okay.
Yeah, I think that you should. So raising it at a high valuation limits your options, right? We always talk about the option value going forward with a company. If you raise it at a really high valuation, you're just setting the bar for an exit valuation. That, I'm drawing a blank on her name. On the Maya's mom deal we did, she wanted to. We did the seed round, and she had an option. She had another term sheet for a much higher valuation. She took ours, which was significantly lower. And then, I don't know, 18 months to the day almost later, she came to us. She said, I'm going to sell the company. And culturally, we won't block you from selling the company, even though we may not want you to sell it, but we won't block it. And we said, how much is, blah, blah, blah. She said, well, it's not what you want. It was a lot lower than what she had originally hoped for. But she said, you have to understand that I own, 58%, 62% of the company, whatever it was, and this is a meaningful amount of money to me, and I really want to sell it. It makes a big difference in my life, and I want to sell it. And so, of course, she sold it. And if she had raised it at a $10 million valuation, she would never have been able to sell it, right? It wouldn't have made any sense. And so raising at this high valuation really limits your option value. And so the question, though, of yes, I believe that you should raise the minimum amount of money you need to get to a milestone that is fundable. You are way better off economically raising a certain amount of money at a certain valuation and then increasing the valuation of that company and raising more money, right? You retain more of the company doing it that way than raising a ton of money at a higher valuation today. You just do. So that's the whole venture stepstone, which I think we should do.
So it's running a lot. So here's a startup question. If we were in the movie Trading Places, and John Burke is now turned into a startup founder, and you can pick any idea, getting the best team in the world, and your goal was to pitch to John Burke and get him to fund you, what would that startup look like?
I have no idea. How am I going to answer that? Because we don't think about companies like that. We think about people.
But if you were going to do a startup tomorrow, if you said, "Hey, screw True Ventures, I want to do my own startup," what would that be?
Actually, I don't have an answer to that. Okay. I really don't. I don't know. It would be something relatively large, but I don't have a great answer for that.
Sure. Okay.
Yeah. But the other red flag, I want to go back to the red flag.
No problem.
So we also we also prefer not to have single founders and not more than 3. So, and the reason is we had a great company. It had 4 founders. I won't tell you the name of it. And it was a very successful exit, but there were 4 founders. They had an offer for, I don't know, say in the high 80 million-ish, $90 million range to sell to a very large company. It was a great outcome for them. It was a great outcome for the company, but we didn't think they should sell. We thought that this thing was on a rocket, this was on a trajectory, and that they should hold out, and in 2 or 3 years, we could get it to $300, $400, $500 million. And we were at an offsite, and you probably all think we spent a lot of time at offsites, but we were at an offsite, and we had them come up for dinner so we could try and persuade them and talk about them to not sell. And I was sitting on the beach with one of them, and it turns out that they were all Russian sons of Russian immigrants, and their parents all cleaned hotel rooms in New York and didn't have any money and didn't own a house, and these young guys were all commuting from another city into San Francisco. And he said, "Look, this is a tremendous amount of money for each of us. We can buy our parents a home, we can change their lives. It's a great story, and you're not going to block that, right? But." They said, yes, we might be able to get it to $300 million, but if you actually look at it, if you spread that across 4 founders to work for 3 more years in an unknown scenario, we actually don't benefit that much for working 3 more years. And so when you start diluting the thing across 4, 5, 6 founders, it really is hard to make the economics work. And then we think one founder is lonely. Starting a company is a really lonely process. I always like to say that fortune favors a connected entrepreneur, and by connecting into a larger group of people, whether it's other founders, whether it's a portfolio company, whether it's a startup grind, whatever it is, you're more likely to be successful. And being a single founder is just harder. It's just lonely, and it's just harder. It's a hard thing to do. And so we would prefer sort of a 2 to 3 founder team. There's lots of caveats and lots of exceptions to that, but that's preferable.
Okay, great. I'd like to switch some gears here because we're running short of time before we open up the Q&A. But I wanted to get into DC Tech and sort of there was an article that I think it was Tech Cocktail. They interviewed you and you said that there was a difference in culturally DC Tech versus Silicon Valley, and you had said that in the Valley, entrepreneurs are extremely collaborative, but VCs are not. Mm-hmm. And then when you come here, VCs are very forthcoming with sort of the deals that they're working on, but entrepreneurs here are not very collaborative. So why is that? Why is that? And how can we be more collaborative? How can we promote collaborations?
Well, I mean, for me, it was anecdotal evidence, but it was true. I mean, when we had our peer office, which we got evicted from, but it was a great office. But we would have all these companies in the office. It was not an incubator, but people would use very much like 1776. You walk in and you see, oh, there's Om sitting there talking, and people would come and pitch deals and go, oh, can I talk to him? And and so that's what would happen. It was very collaborative, and people would say, what are you working on? They talk about it. What's the most exciting thing you've seen? They would talk about it. It was very collaborative in the Valley, and there's just a lot more people in every stage, in financing and startups and customers and partners. And here we have this culture. We had this culture. I think it is changing. But we have this culture of people coming out of. Most of the people who were coders here came out of government contractors where everything was a big secret, right? And it was just culturally that you just didn't talk about what you worked on. And so I think as this starts growing and you get more and more people who are not in government contracting jobs, I think it will change. It will change. But VCs still are very much the same. Out here, they're very collaborative. I can take a VC to lunch and say, what are you working on? What are you thinking about? And he'll tell me what deals he's actually looking at and what they're thinking about and the valuation. All that kind of, in California, it doesn't happen at all. They don't talk about things like that at all with each other. So that has not changed. But I think culturally, we are beginning to change here. The other thing is that they talk about the dearth of talent in this area. One of the big knocks in the DC area is that there have been no huge successes that have spawned many, many other startups. And that is arguably true. And a lot of the talent leaves, right? A lot of the top talent will leave, and it's hard to hire people here. And it's also because a lot of these people work in these government jobs where they're making 200 grand a year. It's super comfortable. They don't have to worry about the next round of funding, and they just keep on going. And so trying to pry them out is really, really hard. But I do think we are changing. I think 1776 has done a great job of bringing people together. It reminds me of our peer office before we got evicted. It really, you have a lot of people working on different stuff, and it's very exciting. So this kind of stuff does help. It is changing.
And then I wanted to mention, like, WeWorks, they're opening up their, I think, 4th office now, and then Uber office is opening up their 4th office as well. So there's some changes, but it's gradual.
But it's open space like this where people can run into other people working on other interesting stuff and just talk about it. That's what's important.
Almost like the Tony Hsieh, 100,000 collisions, like his new headquarters, it encourages collisions.
Yeah.
And so when you have more collisions, more collaborative, more.
We just had this thread on the founders group. So one of the things we do is we try and connect all of our founders together. And one of those ways is through an email list. And when there was just somebody said, hey, we're moving to a new office. It's particularly important for people outside the Valley. But we're moving to a new office. What do you think about doors? And so there's this long thread over the last 72 hours of should you have a door in an office, you do not have an office, you have an open space. And it was that collision. It was that, I want to be in the mix of it. This is all from the founders. I want to be in the mix of it. I don't want people to think I'm sitting in an office. Everybody sits with their screen against the wall so that you can see that they're working. But having that open, collaborative nature even goes within our companies. So the collision thing makes a difference.
So one last question before we open up Q&A. What's the future of True Ventures? I read that you're going to sort of change your role from general partner to venture partner. I didn't know what that is, so I looked it up.
Technically, it doesn't really mean anything. Yeah. But we have 148 portfolio companies. There are 4 here. Right? So dedicating resources and having a tax nexus in a state other than California, it didn't make a lot of economic sense for us to do it. So that's why. I was spending half my time in California. I'm spending probably a third of the time in California now.
Okay. Okay, wait, one last question. So I heard you build furniture.
True.
Okay, so what's the most difficult furniture you built?
Well, chairs are really hard.
Really?
Chairs are really hard, but I don't build like 25 of one thing. I build one thing. I
was going to say you can
donate.
You can donate to 76.
No, I build one thing. I did build this bench out of a live piece of wood that was really hard, but anyway, the chairs are hard.
Okay, great. We'll open up to Q&A. So first of all, do we have any City Pass members here? Raise your hand. Okay. All right. Okay, so first question. Here we go.
Hi, John. I have 2 questions for you. The first one is about your investment philosophy. So I'm just wondering, can you share us specifically what is your investment criteria when you look at the investment opportunity? Then the second question is about your personal career development. You were first entrepreneur, then you became an investor. So how does that part of the entrepreneurial experience help your career as an investor? Thank you.
So I think that having, I wrote this somewhere, but having, had to make payroll, having to talk to customers, working in a company makes a huge difference as an investor, because most of the work you do is on the board, and so working with founders, understanding the pressures that they deal with makes a big difference. Investment philosophy. So we don't invest in. Well, I won't say what we don't invest in. We don't do Series Bs, right, or beyond. We're a seed and Series A investor. Yeah, we're super early. We want to help hire the first 10 employees. We want to help set the culture of the company. You can't do that investing $5 million in a Series C, right? And so that's what we want to do. We do look at deals in sort of a framework of a Mickey Mouse face. And so if you think about Mickey Mouse, he's got a big round head, he's got 2 ears. And we think about the team as the head, right? And we think about the deal as one of the ears, and we think about the market as one of the ears. And those are the 3 things we evaluate. What's not in there? The product's not in there. We want to invest in the best teams. We have to love the team, right? We have to love the team, and we have to like the market and tolerate the deal structure, right? And so that's how we really think about it. And the deal, right? We don't do convertible notes, right? So if it's a convertible note, but the team is just spectacular, we'll try and talk ourselves into doing it. But we want to do a seed equity round in a big market that maybe we understand, but we know the founders do, and we want to love the team. That's what we want.
But then when you see you love the team, it's very subjective. Can you be more specific about that? What kind of quality, or is it a feeling?
No, you want to love the team. We don't like assholes. We don't like people who don't like each other. We don't particularly care for teams that just came together on LinkedIn. We want somebody who's worked together. If you've come from a big company and nobody from that big company has followed you to start this startup, that's kind of a red flag. So it is subjective, yeah.
Let's see here. Here we go, Drew.
Yeah, you talked about the importance of collaboration and the peers and accessing those people. I guess my question is about mentors. And I've struggled in a traditional corporate environment, trying to give them, hey, if you want me to drive someday, someone's got to show me, they got to hand me the keys and they got to show me how to do it. In this space, it seems slightly less accessible, if not significantly less accessible. Can you talk about finding good mentors in an entrepreneurial environment and sort of where to go and what that looks like? Thanks.
Yeah, I wish Tony Conrad was sitting right here, because Tony is like the expert in this. He just blogged about this, about the About.me. He went and he found the advisors to the company, and I won't do it justice, so you really should look it up. But he found advisors. I think he had 24 advisors to About.me. All were super influential in different areas that would actually use the product, and he gave them equity in the company, not vesting. He just gave them outright grants in the company. But he would say, I think if he were here, Tony would say that his path to success with Sphere and also with About.me was because of the advisors. And he will go out and just ask. And he'll just get connected, however he needs to get it connected, and he will just ask. But it is a huge part of the success. Yeah.
Okay, 2 or 3 more questions. Here we go.
Hi. Earlier you mentioned about referrals and how 0 investments have come from just cold calling or cold emails.
Yeah.
But you said that very few investments have come from accountants or lawyers. As an attorney myself, I was just interested to know.
I was just kidding.
Sorry, I don't mean to hide it, but what advice do you have for people who are looking to just help clients or potential clients, to connect them with investors? What is the best way to approach and to, try to connect them with venture capitalists without being either too intruding, too annoying, or just what is the process you recommend?
Yeah, I mean, look, it is a relationship business, right? There are a couple of accountants and a couple of attorneys in this area who have super good noses for deals, right? And when they send a deal, you look at it. I mean, that is just, you know that. But it is getting to know, you sat down so I can't see you anymore. It is getting to know the investor, right? So if you have that relationship with an investor, I'm happy to look and talk to companies and help them out. We believe that we have built True to help the entrepreneurial ecosystem, whether we invest in you or whether we don't invest in you. We want to be able to help the entrepreneurial ecosystem. So we all spend a ton of time talking and helping and mentoring companies that we aren't invested in, right? And when we say no, we're not going to invest in it, we always ask, what can we, other than writing a check, what do you need? What can you want to talk to somebody in the portfolio? How can we be helpful? But it's all about a relationship. It's all about a relationship. So anything you do to make that, to help that relationship would matter.
Okay, well, I think we have time for maybe 2 more questions, but this one's a good one, so.
Yeah, hi, this is Hemant Bundele. Just want to get your perspective on what sort of companies are, being successful at the Bitcoin, in the Bitcoin space. So, there are a lot of startups.
We have no Bitcoin investments. So I really couldn't even begin to tell you which ones are being successful.
You don't have an opinion on Bitcoin, though?
That's a longer conversation than we have time for. Yeah.
Okay, I think we have a question for one. This guy's over here. He has been raising his hand.
So John, you talked a little bit about the consumer wearable space, and one thing that I think has kind of been interesting is if you look at the payment space, the hardware, the consumer end of it started to get commoditized, and Square came under pressure. Do you see the future of wearables? Is it the next big win after plays like Fitbit? Is it going to be in software? Is it going to be in the enterprise landscape? Or is it going to be in consumer hardware? Where are you thinking?
I think it's going to be somewhere between consumer hardware and software. I think there will be a convergence of all those companies you just talked about. But there will be a convergence there. And I think it's only going to be actually that far in the future. I really don't.
Your answer was really short, so I didn't have time to look at it. So
you told me we were running out of time.
No, it's good. We're still good. I mean, I have 2 more questions to ask you. We always ask 2 last questions. So what the second to last question is, if you were sitting in the audience 15 years ago, listening to a badass founder, what sort of advice would you have given yourself?
I always tell, just do one thing really, really well. Don't, so many of our companies start out with that one great idea, and then they just sort of get distracted, and there's product scope creep on everything, and just do one thing really well, really, really well, and be the best in the world at it. And everything you do every day should be focused on that one thing.
Okay, and last, most important question. You ready?
Yeah, I can't wait.
So, who's your favorite superhero / historic figure, and why?
Oh, yeah. So I'm not a big superhero guy. Actually, so I used to have I used to be on the board of a company in Montana. Now that is a hotbed of entrepreneurial activity. Actually, it really is. But anyway, but I love the outdoors, and so I would always try and fly out, 4 or 5 hours early before the board meeting, so I could do some hike somewhere. And I was up in this mining camp, way up in the Bob what's-it-face wilderness. Anyway, it's up in this, and I was walking around, and I was thinking about these people who lived out there. Obviously, it's a ghost town today. And I was thinking about Lewis and Clark and these people who actually lived this life. And actually I was drawing the parallels between what you all do and what Lewis and Clark did. And so the answer is Lewis and Clark, because I think what you all do, you're truly exploring uncharted territory. Lots of you are. And there's not a lot of support for it, and you're kind of hanging out there. And so I just think that ties in together. And it really struck me when I was in this ghost town in Montana. The people that I deal with every day, the people who are all doing all the work, it matters, right? And you're really trying to change the world, but it's lonely, and you're just hanging it out on the edge, and I think it's very admirable.
So I usually send this answer to our speakers beforehand, so I can get an answer, and we always try to do something a little special. We got a little gift for you. It's the Lewis and Clark expedition with StarCraft. Well, here's the thing, though. There's a true and false question in here, so it's in true for true ventures. There was a question here, true or false? Here's the last question. Did Louisiana Purchase double the size of the United States? True or false?
A little crowdsourced? True.
So true. Ladies and gentlemen, John Burke, thank you for coming out. Thank you. There you go.